Cash, it's great to have you on the program. Welcome to Your Money, Your Life.
Thank you for having me.
Cash, it's well known that boomers have done a very bad job saving. What strategies can they pursue in terms of trying to catch up on their savings plan?
That's a very good question. One thing they can do is, or not do, is not panic. A lot of people are coming to that realization that they're perhaps behind. One of the first things I would tell them is to seek the counsel of a planner, ideally independent, somebody who is conflict-free, doesn't have any obligations to any one firm or product manufacturer, for example, and have him or her do an analysis to see where is it that they actually stand. A lot of the times, not often enough, people find that they're actually in good shape. You know, a lot of the times people are just basing it on, I think I need to have this amount for me to be on track. And that amount is just arbitrary.
Is there a rule of thumb that people can follow in terms of knowing if they've saved enough for retirement?
For sure, there are many rules of thumb and people use them in different ways. I generally am not a proponent of rules of thumb. Everybody is different, everybody's situation is different. So what you need to do is really have an assessment of where you personally stand and what you envision your personal future to be. And that's what you should base any and all decisions on.
Okay. Well, let's talk for a moment about boomers who have saved. We know that we're currently in a low interest rate environment. What strategies can boomers pursue to assure themselves that their nest egg will last them 20, 25, 30 years? Because we know, given the wonders of modern medicine, we're all going to live longer. So what can they do to make sure in this low interest rate environment that they won't run out of money?
Thankfully, we are going to live longer because of the wonders of medicine. One thing that they can do is not live by a rule of thumb. For example, a lot of people might say, oh, you're pre-retirement, few years from 65 or whatever milestone that may exist in their mind, and that you should shift to a certain type of investment. I think you should not do that. The fact that we are living longer means we must not only make our money last, but we must make sure that our money eclipses inflation. Because we know everything we need to buy certainly goes up in price on a dollar basis every single year. And the only thing that I've observed, if you look at historical data going back as far back as the 1700s, when we installed the first Treasury Secretary in this nation, if you looked at every 10-year rolling period, and we've had in excess of almost 200 of them, equities or the broader stock market has always turned in a positive showing in every single one of those 10-year periods. So the lesson in there is just because you reach retirement or you're a pre-retiree stage and to shift everything into, let's say, bonds, for example, which conventional wisdom may dictate is not going to make that money last for that period of time.
I'm glad you mentioned stocks because we've seen the stock market run up. Stock market of late has been somewhat volatile. What should boomers who are trying to make their nest egg grow, what should they be doing in this current stock market where the values appear to be quite high and now we're seeing volatility where the market's moving up and down very, very rapidly? What should they be doing with regard to stock market
First things first, ignore the headlines.
Ignore that.
Too many people fall victim to this person said this TV channel said that, this magazine cover said this. I think if you stick to the basics, if you invest in the essentials, which is my personal bias, things that we all need no matter where we are in the economic spectrum, things like consumer staples and food stocks and utilities, things that every single person needs on a daily basis, generally tend to withstand volatility far better than something that may be more of a speculative nature. So if you invest in food stocks, of course they're going to go up and down, but they may not go up and down as much as, let's say, a technology stock or a technology mutual fund. And because of that low volatility, you tend to have compounding that works much better in that environment. And that's how you're going to make your money last.
Cash, if we're looking at someone who's near a retirement or recently has gone into retirement and they're invested significantly in the stock market, don't they have to take a look at the condition of the stock market and be concerned about some of the red flags that are there? Because the last place they want to find themselves is where they were in 2008 when the Great Recession came and they lost 50% of their value.
100% correct. And therein lies a certain tragedy about people who, for example, 30 years ago or 40 years ago, when they were starting their professional lives, had switched on their 401k and started contributing. The fact is, a lot of people have kept the exact same investments when they were 40 years younger. The investments that were suitable and appropriate for when you were that age are certainly not appropriate when you're this age. Those things need to be reinvested. You have to remember that stocks come, as any investment, come in all shades, all sizes. And the good thing is they don't all act in the same way all at the same time. So, for example, you talk about high valuations. We may find certain parts of the stock market maybe, based on whatever metric we're using, valued far higher than something that's a little bit different. Small caps or small-sized companies tend to grow much faster coming out of a recession, and they did that just like they have done in history. Whereas large companies have not come up as much. So one might argue that they're not as overvalued perhaps, or perhaps there is more value to be extracted. So if you have somebody who is retired and they look in their portfolio and they see a lot of, what I call high octane investments, technology stocks, small, mid-sized companies, perhaps it may be time, not in one shot, to start reallocating, rebalancing, and bringing in, staying within the stocks, but coming towards the more conservative end of the spectrum, investing in the large multinationals, companies that have a long history of profitability, that pay back dividends to their shareholders. Because remember, a dividend is also a return on your money.
Correct.
The price of what you own may not go up or down, but if they send you a dividend check 4 times a year, you have a return on your money.
Well, the good news with regard to dividends is the companies have been raising their dividends. So, so your return with regard to the stock investment is becoming a bit better through dividends.
You have to be careful there, because a lot of companies raise dividends because they've run out of ideas to deploy that money.
Okay.
So there are schools of thought. There are people who want dividends and there are people who don't, and that's the financial theory behind it. Okay. So the people who don't want a dividend will never invest in a company that pays a dividend. But some companies who continue to increase their dividends, and that's why finance and investing is an art, not a science, right? There's no right or wrong. Companies that may be raising their dividends may be looked upon as, oh, they've run out of ideas to make better use of this money, so they're just giving it back to us. Whereas somebody else who is actually living off the dividend, or who prefers that their investments keep giving them something back, might say, well, that's a good thing. That means they're actually making more in profit, perhaps.
Right. And of course, over time, the hope is that the stock will appreciate, so you'll have a combination of dividends and stock appreciation.
So
and
your
the
balance
two of them
goes
put
up
together give you an outpaced return vis-a-vis bonds, especially today.
And if you don't necessarily need the income from that dividend right away, perhaps just reinvest it and buy more shares of whatever generated that, whether it's a mutual fund or a stock. And so when it does appreciate, hopefully, then you have more shares appreciating, and that's also compounding at work.
Of course, of course. Boomers who are catching up on their retirement savings, what asset allocation should they be using in order to successfully catch up?
The answer is different for every individual and every couple, because the way people are wired. I'll give you an example. My wife and I are the same age, essentially the same age. But the portfolio that I manage for her does not look anything like mine, because we're 2 different people. Having said that, a boomer who is trying to catch up, without venturing into actual advice, because I want to make sure I don't do that, should still be heavily weighted towards equities or stocks. Because even at a boomer stage, you're still pretty young, and you still need to make this money last for at least 30 years, if you're lucky, if not more. And so going back to the point I made previously, you still need to be within that spectrum of stocks, but you don't necessarily need to be at this end of the IPOs and the small companies and the tech. Maybe you're back here in the boring old General Electrics, the Walmarts,
So are you talking an allocation 50% stock, 50% bonds, or you're talking 70% stock, 30% bonds? What kind of allocation would you be looking at for someone a boomer who's trying to catch up on their retirement savings?
It'll most certainly be greater than 50.
Okay.
And you have to keep in mind, this cannot be something that you just set and forget.
Mm-hmm.
This, if you are working with a planner who is managing this actively, I'm not saying trading, who is staying on top of things, and with whom you have regular reviews, you go to their office perhaps twice a year. These should be, looked at and tactically and strategically managed. If I recommend to somebody, I think, Mr. Smith, you need to have a 65% allocation to stocks, and then I feel that there may be heightened volatility coming down the pike for the next 6 months, we may bring this back to the more conservative end of the stock spectrum. And if that doesn't turn out, and if we have a number of very positive economic numbers and reports that come out that say, well, actually it's going to be much calmer going forward, then we can move that dial a little bit over here. But it'll most certainly be a little bit more than 50. I don't know if it's going to be. It may be more than 70, depending on the person.
So what I'm hearing from you is that it actually is a situation where you will make adjustments depending on changes in the markets.
Absolutely,
is that right?
Absolutely.
Which makes
not
perfect
necessarily
sense.
Trading, but we continuously watch this is what I get paid for, to watch the economy, to see what's coming, what the news are, how things are going to shape out.
Plus, the individual investor who isn't as informed as you are oftentimes is unable to adjust to change. And by the time they hear about change, it's too late. So
Yeah.
it makes
and then
sense.
they're reacting to it.
And exactly. Then
And therein, it's a shameless plug. You really should be working with a planner, because a good planner will remove the emotion from that,
Right.
and will be able to make those decisions for you.
And a planner can also create a reasonable and realistic plan, whereas an individual's plan may not be reasonable or realistic.
No, they generally are not, and that's why you see day in and day out, the vast majority of the people are investing via vehicles like mutual funds. And you'll see a lot of people never really achieve the same level of return, their personal return, that the fund itself that they're investing is actually generating. So how is that possible? A fund that's up, let's say, 30% in 1 year, an investor in it may have only experienced something that's a fraction of that, because they get in and out at all the different times based on headlines.
Now, you mentioned an asset allocation for a boomer who's trying to catch up on their savings. Now, let's go back a generation. So let's go to somebody who's 30, 35 years old. What kind of asset allocation would you be recommending for someone who's got a greater time horizon, has more time in the markets in terms of their investments?
So let me answer that question in the context of where we are today, with interest rates essentially at zero, and they have been for a long time. For somebody like that, I would be very hesitant to allocate too much to fixed income or bonds, as we say, because there is an inverse relationship with the interest rates and bonds. And we know the Federal Reserve has indicated that they're going to start ticking up interest rates very, very soon, which means when rates go up, bond prices tend to fall. And that is too great of a risk to assume for nothing in return.
Right.
When bonds really are essentially paying nothing, why take on the risk to make a 1.5%, 2% when you can buy a stock from an old-time company like a Procter & Gamble, let's say, that's generating a 3% dividend. Why take on that risk to get 2 when you can just sit over here and pick up the 3?
So, Cash, with the asset allocation for somebody who's 62 and potentially retiring versus somebody who's 68 or 70 and is retiring, would that asset allocation be different?
Yes and no, as always. Their allocation needs to have a serious analysis at that point. Then, depending on all of their assets, we're talking about their financial assets. But if you incorporate all of their assets, maybe the asset allocation can remain the same post 62, approaching 65, post 65. But in general, these 5 years pre 65, 5 years post 65. You really have to be very actively engaged in the allocation and be cognizant of everything that's around and what's happening. Certainly when you're 68, you should still look at your allocation, and the allocation should still look almost like it did when you were at 65. It should look a little bit different than when it was 62. But when you're 72, your allocation should look much more different than it was at 62. But it all depends on the personals.
Does your opinion with regard to asset allocation for somebody who's in retirement change if that person is risk averse?
Of course. We always have to keep that in mind because everybody's wired differently and everybody's perception of risk is different. So if somebody is absolutely risk averse and they want to take actions that may not be in their best interest. For example, they want to absolutely go into something that's just going to produce nothing and therefore not going to keep pace with inflation and retain purchasing power, then our job as planners is to educate them because a lot of people just don't know.
Now let's look at the other side of the coin. What about somebody who for some reason can take on tremendous amount of risk and wants to take on what I will refer to as an unreasonable risk? How do you feel about advising that person?
Well, luckily I operate as a fiduciary, so my job is also to educate that individual as well. And I will tell you from experience, the people who are like that as they walk through the door, these are the first people to call you when they see parentheses on their statements and say, what is that? So, in all likelihood, there are a lot of people who think they're a lot riskier than they actually are. And our job is to coach them and educate them properly. There is no glory in losing money.
Cash, it's not unusual that you'll have a husband and wife. They both are employed. They both have very good jobs. They're in their 50s, perhaps approaching 60. They have a very, very good income, but they have very little in terms of savings. They have the ability to save. What advice can you give them in terms of how to go about saving more from that big income that the two of them now have?
Lifestyle changes first. First, we need to look at where that income is actually going. I think it was Benjamin Franklin who said even a small leak can sink a ship. A lot of people, when they actually start looking at what they're spending money on, are shocked many a time to see, really, I spend that much on XYZ coffee every morning? So the first step is to actually look at where your money is going. And then behavioral changes and lifestyle changes make a big difference. Eliminating one expense, one premium package on your cable or satellite bill that you, if you think about it, well, we never watch any movies. So eliminating that ends up saving a lot of money every month that could be saved and invested.
Now, Cash, let's consider for a moment husband and wife again in their mid-50s to 60. They're both making a good income, but they also have a 401k through their company. At what point is it advisable for this husband and wife to be working with a financial planner to